a lot of very risky assets, and then over the course of this year, they've been able to adjust those a little bit. There's been a little bit more give, shall we say, from an accounting perspective. Mortgage securitization, as we showed a little bit earlier, is still out of order. It's not working. There's very little to none being done. In yesterday's Financial Times, there was an announcement about a survey of direct mail that showed that U.S. credit card issuers have substantially pulled back on the number of mailings. I'm sure most of you can just anecdotally identify that you're not getting as much mail from the banks as you used to get. And in fact, in the third quarter, over the third quarter of last year, those mailings are down 71%. And compared to 2005 and 2006, the volume that's going out today is only about 20% what was going out. Bank credit is still contracting. We've had 21 consecutive weeks of loan declines. It's been a decline of over $200 billion. And essentially, that's a record decline of about a 15% annual rate. And it's been across all lines of business: commercial real estate, consumer, corporate, all lines of business. Through June of 2009, 27% of institutions were unprofitable. That was up from 12% in 2007 and 8% in 2006. Return on assets was a very meager 0.04%. Normally, a healthy institution wants to see that number north of 1%. And if you're doing 1.2 or 1.4 or 1.6, you're doing very well. Today, announced in the United Kingdom, so a little bit remote, but still indicative of the problems, there has been a second bailout of RBS and Lloyd's with an additional $51 billion being pumped into those two entities. Lastly, let's take a look at the fiscal stimulus from Congress. On the next page, I'm on page 13. The fiscal stimulus has primarily come from two acts. Now I've got the names of it. The Emergency Economic Stabilization Act, that's what was enacted in September of 2008, and the American Recovery and Reinvestment Act, which was enacted in early February of this year. And this is kind of, again, a sort of a spattering of some of the things that were going on. The most recent act includes tax cuts and benefits, education and health care, unemployment extensions, grants and loans. There's heavy emphasis on infrastructure. And this was kind of a double down, you might say, that Congress did. $700 billion was given the Treasury, and then basically another roughly $800 billion coming out more in general spending. Of that $787 billion so far, about 26% of it is out, or about $207 billion. Interestingly enough, more is being considered. I imagine some of you have heard about sort of a parallel to cash for clunkers, sort of a appliance clunkers kind of thing. I'm not exactly sure what it's called. And then there's active discussion about the extension of the new homeowner credit. Quick aside, if you have any interest in following this, and I'm not sure many of you do, but I know there's a few of you that like to kind of squirrel around in some of this in terms of topics. There are a couple of very good websites that the government has put together. One is called recovery.gov, and then one that's put together by the Treasury is called financialstability.gov. A lot of information, a lot of reports. All the reports that they're providing in Congress get posted there. A lot of data, all the 600 different institutions that got money, they're all listed, how much they got, whether or not they've paid any of it back, that kind of a thing. So before we turn to the debt side of the paradox, let me recap a few items. The Federal Reserve stimulus, how much was it? If you look at an increase in the balance sheet, it was an increase of about $1.25 trillion. And there are additional plans that are likely to take that increase up to about $1.8 trillion. Again, it's very hard to measure the impact of the decrease in interest rates, but that's got to be a very large number. It's very important. The Treasury got $700 billion from TARP with $635 committed so far. The FDIC bailout costs so far are $51 billion, and the potential could be much larger. We don't know how long this is going to run. Congress, in those kind of large buckets that are easily identifiable, you've got the amounts that they funded in TARP that they gave the Treasury to disperse, and then you've got the amounts from the AARA funding that was announced earlier this year of $787 billion. There was another about $88 billion announced in the fall of 2008. primarily in the form of tax breaks and some miscellaneous things. And then there's those institutions out there, Fannie Mae and Freddie Mac, each of them got a commitment of $200 million apiece. So far that cost has actually been, $200 billion apiece. So far the bailouts for them have cost us $288 billion. When you put that all together, we're talking about $3.7 trillion that is already in play or committed to following. Basically, we're putting that out. The Committee for a Responsible Federal Deficit estimates that stimulus so far has been $3.8 trillion. So I was kind of piecing things together from a different angle and came up with a slightly different number than what they do, but still in the very close neighborhood. And they identified that potentially you could have stimulus almost as high as $12 trillion were additional capacities tapped. $3.7 trillion, how much is that? Well, that's about 26% of GDP if it all went out in 1 year. GDP is about $14.3 trillion. And so if we're probably going to split it out over about a 2-year period of time. So we're talking about a 13% additional stimulus, additional amount of money floating around in the system because of the stimulus. What has the U.S. taxpayer received for these expenditures and investments? Well, we've seen about a 60% increase in the stock market. Whether or not that'll hold, who knows? Bank lending is still declining, and banks are paying themselves a lot of money in terms of executive compensation. We got that. The credit that is supposed to grease the economy is not doing its job. We have the privilege of owning meaningful or large percentages of 5 companies that are still in deep trouble. And if you think about the automotive and financial industries and how they've been put together, there are some very severe structural problems. And I think that we'll own those companies for a while. The taxpayer is serving as a backstop for virtually all of the new mortgages being underwritten today. I don't think we should have to worry about the number of borrowers who redefault on their modified loans. How much is that? 56% of loans modified the second quarter of 2008, for example, redefaulted. We shouldn't worry that even though subprime lending was a huge debacle, recently the FHA has been increasing lending to borrowers with FICO credit scores lower than 660, which is in that subprime category. Now about 20% of the volume from the FHA is in that category. Interestingly enough, it was about 20% of the volume at the peak of the market before things rolled over. That's what subprime was. Christina Romer, the chair of the Council of Economic Advisors, has told us that the ARRA stimulus added 2 to 3 percentage points to GDP in the second quarter of this year, added 3 to 4 percentage points to GDP in the third quarter of this year. And what that means is that basically we would have had a negative GDP in both quarters. She also said that the fiscal stimulus has its greatest impact on growth right around the quarters when it is increasing the most strongly. And so the impact on future growth, things will slow down a bit, and it ultimately will be a drag on GDP as the stimulus is reduced. Reportedly, there have been jobs saved, jobs added, estimates ranging from about 600,000 to 1 million jobs. Probably the most important thing that has come out of all the stimulus is that we averted, at least this time, a complete meltdown in our financial system. We're busy substituting public debt for private debt. Private debt is starting to come down a little bit. But it doesn't matter how you count it. $3.7 trillion is one heck of a lot of money, and that is one irresistible force. And so Tom is now going to comment about the other side of the paradox and the immovable object of the debt.